Good evening, everyone. Thank you so much for joining us today on our 2024 tax update with our amazing friend, Timothy Roscoe Carter. He has been supporting the credit union since 2025 with his amazing knowledge of taxes. And as you come in to the room, today is National Science Appreciation Day. Everybody loves a little science. And today is World Math Day. As a financial literacy teacher, I love math. Today is Celebrate Purple Day, which was in tribute to epilepsy, or if you're a Prince fan. And also it is Good Hair Day celebration. So I know all of you guys are looking amazing. So thank you for coming. So remember, please use the chat for your comments. We want to hear from you. We're going to utilize the Q&A, but remember we're talking about taxes and it's very individual, so it's going to be hard to answer all of your questions. But Timothy is very gracious and he will take your questions via email. So don't panic. It's going to be a lot of information, kind of like drinking water from a water hose. But remember, we are going to be recording this and you will all be sent a link. So if you hear something that you really want to revisit, we'll be sending you a link to this presentation within a week of the presentation. And we also have coming up, we have on our next webinar is not going to be on the Wednesday, it's going to be on the Thursday, and it's Teaching Kids the Language of Money. April is Financial Health Month and Financial Health Youth Month. So the beginning is going to be teaching kids the language of money with a wonderful, wonderful presenter, Nicole. And then our 23rd one is going to be April the 23rd at 5:30 is going to be our Smart and Safe, a guide for fraud prevention. There's been so much fraud going on. It's always good to have an opportunity to come and make sure that you're getting the latest information so that you won't be scammed. So please put your hands together and welcome Timothy Roscoe Carter, who's been supporting our members since 2020. So this year, Timothy, is your 5th anniversary. Congratulations.
Yes, very happy about it. Yes.
Okay.
Yeah. Thank you very much, Veronica, and thank you to Patelco for giving me the opportunity to share this information with people.
Right on.
So I am the qualified tax expert and the supervising attorney of the Low Income Taxpayer Clinic with the Justice and Diversity Center. We are a nonprofit associated with the San Francisco Bar Association. Next. So what is a low-income taxpayer clinic? We're a national program funded by the National Taxpayer Advocates Office, which is a semi-autonomous branch of the IRS. We provide free representation to low-income taxpayers before the Internal Revenue Service in audit, appeals, collection, and before federal court in matters of tax litigation. We do receive matching funds from the IRS via grant program, but we are completely independent of and not associated with the federal government. Our job is to oppose the IRS in controversies and represent the taxpayer. And every clinic we have our own. We have certain guidelines of who we can represent, but we also independently make our evaluation of each case. Next. And our job is to help ensure the fairness and integrity of the tax system by educating taxpayers about their rights and responsibilities, which is what I'm doing here today. and providing free representation to taxpayers in tax disputes with the IRS and in tax court. And we identify and advocate for issues that impact low-income taxpayers. In addition to the free representation, I would also mention that we do consultations as well, where we are not necessarily representing you, but we will give free tax advice. And for that, we have no income guidelines, so I can provide a consultation for anyone. Next. So starting off things that change, this is just a kind of reminder. And if you need the actual numbers, you can look them up. But every year there are items on the in the tax system that get changed just by following the inflation. And those include your standard deduction, marginal tax rates, the alternative minimum tax exemption, the maximum earned income credit, standard mileage rates, contribution limits for retirement accounts, and maximum credit for adoption. So if any of those things, if you know the amount of any of those things, it's liable to have changed, particularly with the inflation that's been happening recently. Next. Now there's two big groups of things that are of items that are scheduled to expire after the end of this year, so that they're good through the end of this year. One group is items in the Tax Cuts and Jobs Act, which that was enacted by the first Trump administration in 2018, and the entire thing is scheduled to end at the end of 2025. I'm going to go through this, but these are things to watch out for that are currently in the law scheduled to expire. Whether or not they will expire will depend upon what Congress does, and they're likely to extend it. They're probably going to want to make it permanent. I don't think that'll happen, but they'll probably extend this for another few years. But if they don't, this is what's going to expire. There will be a reduction in the standard deduction, and then there will be the return of the personal exemption. So you used to have a personal exemption and a standard deduction. They eliminated the personal exemption and increased the standard deduction. That'll return if this does expire. The qualified business income deduction expires. That was something that was new with the TCJA. There will be an increase in marginal tax rates and a return of deductions for personal casualty and theft losses. There was a whole group of deductions that were eliminated by the Tax Cut and Jobs Act, and those were some of them. Next. The deductions for miscellaneous expenses, which included for if unreimbursed employee expenses and your if you're paying for tax preparation, those type of things, you can't deduct them now. If the TCJA expires, that will come back. The child tax credit will be reduced. There will be a return of the partial phase out of itemized deductions for taxpayers with incomes over $267,700 or $320,000 for married filing jointly. So yeah, it used to be the itemized deductions. Generally, you had to be wealthy enough to have items to itemize, but then it phased out for very wealthy people. Now it doesn't phase out, and the very wealthy can still take them. Whether or not that continues to be that way depends upon whether or not this gets extended. Next. Um, so there's new rules about the 1099-K, which is a form that is used to report certain electronic financial transactions. And like all 1099s, the person who's required to report will be sending a copy to you if they're reporting about your transactions, as well as a copy to the IRS. Next. So yeah, it's an information reporting form. It's issued by third-party electronic payers, such as credit card companies, PayPal, Venmo, etc. And yeah, the payee and the IRS gets it, and it's for business transactions. That's the intent, for business transactions. Next. Next. Okay, so the old rule, and this is why a lot of people hadn't heard of the 1099-K, they were only required if a payee receives at least $20,000 from the payor, the company, during the year, and they receive at least 200 payments from the company during the year. So basically, this was only something that was sent out to um, really like large businesses, people who had a lot of transactions amounting to a lot of money. Next. So the new rule is that a 1099-K will be required if the payee receives at least $600 from the company, from a payor, or company during the year. The number of payments is irrelevant. So if it's just one $600 payment, they have to report. This was originally scheduled to begin tax year 2022. They had a partial um, uh, they they had a partial implementation of it for 2024, and it will begin in earnest for tax year 2025. So you can expect these transactions to be reported to you and the IRS. So yeah, the transition for 2024, and you might be receiving them as the payee receives at least $5,000 from the company or the payor during the year, and the number of payments was irrelevant. So they eliminated the number of payments for last year. So if you received over 5,000, you're likely to get this, and then for 2025, you're likely to get it if you receive over 600. Next. So things to know about this is that it doesn't change if you're the payee, it doesn't change your tax reporting requirements or your tax liability. So it's not something that you are necessarily going to be taxed on. It's not going to, or it doesn't add to anything that you would otherwise be taxed on. If you were going to be taxed on it, you would have had a requirement to report it, even if you didn't get the form. And then so companies might be issuing 1099-Ks for 2024 under the new rules, because some of them just don't want to bother like having different rules for transition. They just put in the new rules and don't have to worry about it. So they may have done that for 2024. And so you may be getting them even if it's under 5,000. And a major thing to look out for is the potential for mistaken reporting of non-business transactions. This is particularly relevant, some for PayPal, very much for Venmo. Venmo is used for both business and people use it for both business and personal exchanges of money. So if you get something from Venmo showing that you have all of this income, it's not necessarily income, and you just need to be aware of it. You don't have to report it, but you need to be aware of it and keep the records. So if the IRS comes calling, you can respond to them. If you need to know how to respond to them, give me a call. So this year, there are retirement account changes that we can go over here. Next. So there's the required minimum distribution failure penalty. The old rule prior to 2023, there was an excise tax of 50% was imposed on the amount you failed to withdraw. So you're required to withdraw a certain amount from the account each year. If you didn't make that requirement, the tax was 50% of what you were supposed to have withdrawn. Next. But under new rules, the excise tax is just 25% of the amount you failed to withdraw. So for 2024, if you didn't withdraw what you were supposed to, the excise tax is only 25%. But next, you have an opportunity to lower the penalty tax to 10% if you correct the error within 2 years. So for 2024 and for 2023, if you didn't take out the required minimum distributions, you should go ahead and do that immediately, and you can reduce the penalty to 10%, and you can possibly have it waived for reasonable errors. What's reasonable? Not really. I don't think this has been around enough for that to be established, but so just go ahead and try. And again, you can call me for help in terms of how to go about requesting the waiver. Next. Okay, so for 401k plans for contributions, there's a new thing where they allow super catch-ups. So there's always been a limit to how much you are allowed to contribute to 401k plans. Since 2001, what they instituted a catch-up program so that for people 50 and older, participants 50 and older, they can there's an extra amount that they can contribute. That way, if they haven't been putting enough in, they can try to catch up by putting in more. So, for example, in 2025, the general contribution limit is 23,500, and the general catch-up amount is 7,500. But if you could go back, I think, yeah, thank you. But beginning in 2025, so that's for this year, the plan participants age 60 to 63 have higher catch-up limits. For 2025, the limit for people 60 to 63 is 11,250 instead of 7,500. So there's a limit for people under 50. There's a limit for people 50 to 59, and now there's a new even higher limit for people 60 to 63. Okay, next. Also, beginning this year, 401k plans established after 2022 must automatically enroll employees. So the automatic enrollment amount must begin at between 3 and 10%, and it'll increase 1% annually until it's between 10 and 15%. So your employer will automatically be enrolling you and automatically taking out the contribution. However, automatic enrollment is not mandatory enrollment. So employees may reduce or eliminate their contributions. So if you don't want to be enrolled, or if you see that you're enrolled, look at your payroll stub, and you don't want to be enrolled, then contact your HR department and let them know. And they'll probably have their own form to let you know. And also, so there's new rules for inherited IRAs. So if you inherit an IRA from someone who died in or after 2020, you must withdraw all of the funds by the 10th year following the date of death. So if it was for somebody who died in 2020, you begin in 2021. And so for 10 years, which would be through 2030, then you would you within that amount of time you would need to withdraw all of the funds. Okay, next. So there are exceptions to the new 10-year rule, which is that you can withdraw IRA funds over your lifetime, beginning the year following the date of death, which was the old rule. And you can still do that if you are a surviving spouse, a child of the decedent under age 21, a beneficiary who is not more than 10 years younger than the decedent, or an individual who is disabled or chronically ill. Energy tax credits. This is something I talked a little bit about last year. It's still fairly new and relevant. So they were recently expanded. The energy tax credit for the installation of certain energy saving improvements to a principal residence was extended through 2023. It increased to 30% of the cost and to a maximum of $600. Next. The solar energy tax credit extended through 2032 and increased to 30%. And starting in 2023, the credit you've been able to claim that for qualifying battery storage as well, not just the panels, but for the battery storage. Next. And the tax credit for qualified motor vehicles was extended through 2032. And the criteria for new vehicles has expanded, and now it applies to some used vehicles. Again, these are things that if you're planning to use any of these energy tax credits, you'll want to keep track of the news. It's hard to say what's going to happen with them. I know a lot of these credits were not liked by a lot of the Republicans who are now running things, but whether or not they change it, we don't know. Whether or not the fact that Elon Musk is helping them might make them like some of these credits more. I don't know. But so just keep an eye out on the news if you plan to be using these. Let's see. Oh, and also, yeah, there's a tax credit beginning 2023. A tax credit can be claimed for installing an EV charging station in your home, and this credit runs through 2032. Again, one that I think Musk would probably like. And then this might be hopefully the last year that I talk about the pandemic. Again, this is a lot of things. I mentioned that there were two groups of things that are scheduled to change for a lot for into 2025. The first one is Tax Cuts and Jobs Act. A lot of the pandemic changes are also scheduled to go through 2025. So, for example, student loan payments that are made by an employer on behalf of employees up to $5,250 per year are tax-free to the employees for payments made from where the pandemic began in 2020 through the end of this year. So if you're in a position to make a payment like that to one of your employees, or you have an employer who might be interested in that, that's something you should do this year so that it is not taxed. And then also, if you did not get your stimulus payment for 2021, you have until you have just a few weeks now to claim it. You would need to file a claim for it, usually either an amended return or an original return for 2021, and it needs to be filed by mid-April of this year, 2025. And then there were some changes that that were permanent, with the expanded earned income tax credit. It's now available to some taxpayers who file as married, filing separately. The investment income limit was permanently increased to $10,000, and a single filer EITC is available to taxpayers with children who do not have Social Security numbers. Next. And then this is some ACA, that's the Obamacare assistance, and there were provisions that were extended to this year, and so this will be the last year. So the 400% federal poverty line cap was removed. Premiums for benchmark health plans were capped at 8.5%, and individuals who make up to 150% of the federal poverty line are eligible for zero premiums. Next. Some other permanent provisions include the protective equipment purchased after 3/12/20 qualifies for special teachers unreimbursed expenses deduction, which is an employee unreimbursed expenses deduction that can be taken even though they eliminated those type of deductions for virtually all other jobs. And then you can they made it permanent that you can put on itemized deductions medical expenses above 7.5% of your adjusted gross income. Previously they had scheduled it to increase to 10%, but they brought it back down or kept it at 7.5% permanently. Next. So the general rule for home mortgage debt that gets forgiven is that it counts as taxable cancellation of debt income. However, canceled principal residence acquisition debt, that is the home, if you went into the debt to buy your principal residence, that cancellation of debt is excluded from income up to a certain amount. From 2007 to 2020, the exception was up to $2 million or $1 million for married filing separately. And then from 2021 through the end of this year, the exception is up to $750,000. So if that's something that you're looking to work out, home mortgage debt, and you're trying to work out or thinking about trying to work out some sort of debt cancellation with the lender, now's a good year to do that. Next. Also, similar with student loan debt cancellation, usually, again, it's treated as normal cancellation of debt income. However, all student loan debt cancellation that occurs from December 31st of 2020 through January 1st of 2026 will be tax-free. So again, if you have some way of working that out or planning to try to work that out, do it this year. Next. So for home working expenses, again, there wasn't really any changes for the pandemic, but it was an issue that became very important with the pandemic. So our home working expenses deductible. And for employees, no, for now, because this would be considered, assuming that these are expenses that are not reimbursed by your employer, that would be one of the deductions that was eliminated by the Tax Cut and Jobs Act, but it's eliminated through 2025. So if you are working from home and spending a good bit of money for that is not being reimbursed by your employer, keep an eye out on the news to see if your ability to deduct it comes back as it is currently scheduled, or if they extend that. Self-employed individuals, if you're self-employed, you can deduct it. It's a business expense as normal. So for casualty losses, they are limited to those that are attributable to a federally declared disaster for tax years 2018 through 2025. At the end of 2025, again, if they don't make changes, which they're going to make some changes, but who knows if it'll affect this, but it's scheduled to where personal casualty losses can come back generally as a deduction. But for now, no, unless it's attributable to a federally declared disaster. And the recent ones in California for 2024, in the month of January, San Diego was considered a federally declared disaster due to severe winter storms. And in January of this year, Los Angeles was declared a federally declared disaster due to fires. Now, there were a lot of other disasters and fires, things that were declared disasters on the state level that were not on the federal level. My research came up as these are the only ones for 2024 and so far in 2025 that have been federally declared. This loss applies to property destruction, not lost wages, and you cannot deduct casualty losses if they get compensated by insurance or relief payments. And again, if this is a casualty loss to your business, then that's a business expense and you can deduct it as normal. And that includes self-employment. Next. Free tax preparation. This is something I want everybody to know, that there's a program. There are two programs here. One's the Voluntary Income Tax Assistance, we call it VITA. It offers free tax help to people who generally make $60,000 or less, persons with disabilities, and limited English-speaking taxpayers who need assistance in preparing their own tax returns. And there's also tax counseling for the elderly, a free tax counseling service and preparation for those 60 and over. You can find these by going onto the IRS website and just doing a search for VITA or for the TCE, and it will come up generally by region, and you can choose where you live, and it'll give where local places to do this are. I know there are dozens in the Bay Area that help people with this. Next. New for this year, there's another free option called the IRS Direct File. This was a IRS Direct File was a there was a pilot program last year, and it was very successful, and they expanded the pilot program during the tax season. But now it is officially available in 25 states, including California. This is a tax preparation software that's provided by the IRS. And it's not provided by private companies. It is the IRS itself on the IRS website. And it is online tax preparation software. And it is, and if you qualify, it is completely free. And you'll directly filing. Yeah, and one of the good things about it being with the IRS is that the IRS gets most W-2 and 1099 information is sent by employers electronically to the IRS by the end of January, and so often they already have your information and can just fill it in themselves. And then after it's available through October 15th. And then and after you file with the IRS, and you're from California, you'll be given a web link to CalFile run by the state where you can directly file your state taxes. Next. So requirements, for income, you need to have a W-2 wage income. You can have W-2 wage income, Social Security income, unemployment compensation, interest income, retirement income, or Alaska Permanent Fund dividend. So any other type of income, you can't use this right now. That would include, like, if you're gig economy, independent contractor, you have your own business, you get rental income, uh, royalties, those sort of things. You won't be able to use direct file. Next. And with deductions, you can claim the standard deduction. You can get student loan deductions for student loan interest, educator expenses, health savings account contributions. And you can't use direct file if you itemize deductions. Next. And then there are a lot of credits that you can claim, particularly earned income tax credit, child tax credit. Those are the two big ones, particularly for low-income people getting with the refundable credits. Those are available, as well as credit for other dependents, child and dependent care credit, premium tax credit, the credit for the elderly or disabled, and retirement savings contributions credit. Now, what happens if you prepare your taxes and you owe money and you see that you can't, it's more than you can pay at the moment? What should you do? You should go ahead and always file your tax return on time, regardless of whether or not you can pay. The consequences for not filing and not paying are a lot worse than if you file but don't pay. Options when you owe taxes, there's you can set up, there's several different types of installment agreements that you can set up. You can request an offer in compromise where the IRS may agree to accept an amount often much lower than what you actually owe. Or if you don't qualify for offer in compromise, they also have something you can be put into currently not collectible status if you're low enough income that the IRS believes that it would be a financial hardship for you to pay your taxes. Next. So yeah, if you have any questions, you can call us at our intake line or email us.
I'm going to go through some questions here.
I'm tempted to do the last question first because it was something that I was tempted to talk about.
Okay.
But well, maybe I'll just go ahead and do that. The question is, huge IRS layoffs and closing of office. Will you be able to even reach IRS if help is needed? Unfortunately, that could very well be a problem. Their response time has gotten very good over the last year and a half since the new funding came in. But they've already laid off over 7,000 people. Most of the layoffs were new hires, which means that a lot of the new people brought in to do the customer service calls, a lot of them have been let go. Plus, they are letting go. They're trying to require people to work in the office, and a lot of the new people that they hired were hired on because they thought that they were told that they could work from home, and they have been working from home, and a lot of them may quit because they're not able to work from home anymore. And the 7,000 who have been laid off already are just the beginning. Some senators are worried that it could be up to half the IRS workforce. I don't have a lot of positive things to say. I know, um, I guess for wealthier people, there might, they might, it might be better for them because you might be less likely to be audited. I don't think it's going to affect middle to low income people much in terms of your likeliness of being audited, because usually um, uh, middle and lower income people are audited by computer automatically. It's not really worth the IRS's time to send humans after them. So, and those will continue. And the unfortunate thing is, the computer is a blunt instrument, and you need the people to help you when things go wrong, and they might not be there. Um, so let's see. What do we have here? Is it true that if we use standard deductions instead of itemizing on Schedule A, that our state refund from previous year is not taxed? If this is correct, there is a limit of is there a limit of income made during the year or the amount of state refund received that affects this? Um, I'm That's something I haven't worked with a lot. I know it can be kind of complicated, but basically, um, this is correct because if you um, itemize your deductions, generally there is uh, a the you can take off state income taxes that you paid. But then, of course, if the next year, if you get a refund from the state, then that would be income because you already deducted it. However, those deductions are only are subject to limits. They can uh, it ends up being a very complicated um, uh, um, formula to figure out how much you actually have to count as income. But yeah, if you took the standard deduction and then you get a refund from the state, you don't have to worry about it. It's not taxable then. Um, Vita volunteers will not help self-employed. Yeah, that's generally the case. I think if you are self-employed and you need help getting your uh, Schedule C taxes and you meet the income requirements, give us a call. We can't do it ourselves, but I'll try to find somebody. I think there are a few Vita sites that do it, but that's extremely rare. So if you're in that situation, give me a call and we'll try to find a referral. I'm not I'm not going to guarantee we can, but I think there are some that are out there. If you qualify, meaning you're low income, well, again, I think may have been talking about direct file or Vita, and generally, I'm not sure with direct file that there's actually an income limit. But with both Vita, there's definitely an income limit, and with both Vita and direct file, qualifying also means certain types of income often and certain types of deductions. So if it's a more complicated, they won't be able to do it like they were talking about with the Schedule C. And then certainly Schedule C income on you can't direct file. Which, okay, let's see what else has come in here. So does the IRS prioritize wealthiest people? I'm not I'm not sure what that means if prioritizing for what. I know, like in terms of the um, of people audits, they definitely prefer to go after the wealthy. Like Jesse James. Why did Jesse James rob banks? He said, well, it's because that's where the money is, and that's the way they feel about uh, uh, generally the auditors. But again, the computer system just does matching and can do that really quick. And that and that they'll do that for everybody, but it it tends to it tends to get lower income, middle income people as much, if not more. Do you want to discuss IRAs? I I can. I don't know what specific question you might have. I don't think there's been any major changes, which is why I didn't include it here. Maybe that's something I'll consider next year. Just a general overview of retirement plans might be good for this next year. Can I file standard deduction for federal tax, but itemized deduction for state? I'm actually not sure. I think you can, but I'm not positive on that. Someone wrote positive thing to say, get rid of trust, Trump must, Doge not even legal entity, question mark. I'll read that because it's a question, but I'm not going to comment.
Wise man.
Is it standard that 25% of your income gets taken out of every paycheck for taxes? Well, no, it depends on what you put on your W-4 and how much you make, because they have the your W-4 form, which you fill out for every employer when you become employed, lets them know your situation in terms of how much that they should be taking out. And if your situation changes, if you find that you at the end of the year you typically pay a lot, or if you tend to get a big refund, you might want to change your. You can go in. You're legally allowed to give them a new W-4 at any time, and they will change your withholding. And neither owing a lot nor getting a big refund is actually a good thing. Obviously, you don't want to just suddenly owe a lot, because not only is that generally bad planning, but even if you sort of planned for it, the IRS wants it paid as you go, and they will charge you a penalty for not paying during. So if you owe too much, they'll charge you a penalty for owing. On the other hand, if you get a large refund, that really means that you gave the IRS a tax-free, an interest-free loan of your money. You don't need to do that either. So try to get it, within 1,000 or so of either way. But no, it's not necessarily 25%. Other people commenting on Doge. Does direct filing on IRS website allow for save and continue later, and for making corrections, or allow to file amended returns? I haven't used it. I do believe that you can save and continue later, and you can make corrections in the sense that before you hit the submit button, I'm pretty sure you can make corrections. But once you hit submit, it's submitted. And they do not have it set up for filing amended returns at this time. So changing your mistakes would require an amended return. See.
Yeah, it looks like we're coming to the end of our questions. Everybody can also feel free to email us at webinars@patelco.org and ask questions to Tim, or you can use his email or his intake number to further ask more specific questions.
Yes, please.
Right now the world is a little bit upside down, but hopefully at the end of the day, hope doesn't die.
Yes.
So
I agree.
I just wanted to thank you, Tim. You always are so knowledgeable, and you answer so many questions, and you're the right man for the job.
And thank you again for having me. And this is always a wonderful experience. And thank you to everybody who came to listen to me go on about things that are generally not considered interesting. So thank you.
You made it interesting. I will see you guys then coming up on our next webinar. Thank you so much for spending your evening with us. And I hope you have a fabulous night and a happy spring. We'll talk to you soon. Bye.
Bye.
Hey, thanks for watching. Want more financial advice? Make sure you watch the next video here. And you want to hit that subscribe button here.